Hi all, in a previous video I made the point that beating the market can be difficult and may not even be the best strategy for the average employee. But this video is aimed at people who vehemently insist that beating the market violates the laws of physics, say that you should never even try and instead just give up completely. But if the market is not efficient, then why do many funds fail to beat the S&P 500? Well, there are many reasons of that and let's go through all of them. Those funds are usually very large and therefore have way less investment opportunities compared to what you have. It is so much easier to double $100 compared to doubling $100 million. Right? Imagine you're managing such a fund and you found a company where you are extremely sure that it will double next year. The problem is you have $100 million, but this company is worth only $1 million. So large funds don't care about small fishes in the sea like this opportunity, right? It's like you can say the same about business opportunities. Google can launch a product, but if it fails to completely dominate the market after just a few years, they will discontinue it. For them, a 10% market share is considered a failure and not worth their time. But for a small company, even a 1% market share can be considered great. Therefore, there are many opportunities in the market that large companies just don't care about. Another reason is that some funds don't even try to beat the market. They have different goals like preserving capital, and they achieve this by reducing risk and reducing volatility. Of course, this means that they have less returns, but this is the whole point of these funds. Other funds who also don't even try to beat the market only care about collecting fees. Right, management fees that you pay to those funds. And usually in my country it's often funds who are being sold to less knowledgeable people, like for example forests in Switzerland, and then they charge a 2% management fee and don't give a shit about returns. Why? Because they just collect the fee and that's all they care about. Other funds are completely legit, but they suffer from having stupid customers. Let me elaborate. So imagine you are managing such a fund and you saw that Nvidia has rallied 100%. Of course, now it's already too late, but you can be sure that one of your customers will call and ask about having Nvidia in the portfolio. So, because you don't want to be screamed at through the telephone, you buy Nvidia even though it already rallied. And now if the customer calls and asks about Nvidia, you can say, yeah, we've got that. Because you only care about a 2% management fee that you collect anyways. And if you have really stupid customers, like for example, imagine the market has crashed, now all your customers try to pull out the cash. They tell you to sell before it goes down even further. And now you as a funds manager don't have the cash to buy the best dip of your lifetime, right? Because your customers will come back after it has rallied. And this back and forth will completely ruin your returns. Of course, there are a few other funds who consistently beat the S&P 500, but they have such extremely high fees that after the fees you still end up underperforming. So now if we look at all those funds and compare them to the S&P 500, it becomes obvious that they cannot compete. But people use this as an infallible evidence and insist that you better give up forever. But this does not prove that the market is efficient. Quite the opposite. It shows that there are large numbers of investors who don't care about maximizing returns as much as you do. And this leaves opportunities. So if I buy an ETF for the long term, and I don't care about short-term volatility, right? So it allows a scalper to use this to quickly resell the stock back to me at a razor-thin margin. And because it's, for me, I only care about the long term, this is a win-win for both me and the scalper, right? And a lot of the market does not care. This creates opportunities for arbitrage. During QE, money tends to flow from safer assets to more risky assets. And as we saw a few years ago, when the Fed started raising interest rates, the opposite started happening. But why would someone sell shares of his S&P 500, which returns roughly 7 to 10%, for a governmental bond which yields something, I don't know, maybe 4 to 5%? Why? Because it's less risky, and for some people, reducing risk is actually what they want. Think about it. If I offer you $10 right now, guaranteed, or give you the opportunity to roll a dice and you either get nothing, or if you roll a 6, you get $20. You will probably pick the $10 because it is way less risky. And this is why for many investors, rotating their money from indices or tech stocks into something safe is a good deal. And because this rotation into safer assets leads to a price drop for riskier assets, it will cause even more investors to also rotate into safer assets. It's a self-fulfilling prophecy. But for me, with a longer time horizon, who can wait until QE returns, I have the opportunity to find undervalued stocks. But how can stocks be undervalued if the market is efficient? It is because the market is not efficient. It is because a large group of investors simply does not care, and I can take advantage of that. Arguing with believers of the efficient market hypothesis is a waste of time, because if you beat the market, they will simply say, yeah, but you took on a higher risk. So what? It just proves the point. You can even show that adding some Bitcoin to your portfolio improves the Sharpe ratio of the portfolio. But then they will move the goalpost to, but can you beat the market over 5 years, 15 years, 40 years? Do I have to? No. If I don't find any investment opportunities, I can always go back to just holding an index fund and wait. You can always cherry pick statistics to prove that outperformance is not possible. People who do so are the same people who, when you tell them about your business idea, they will simply say, if the idea is so great, then someone else has already tried it and made billions. Then they show you statistics about the percentage of companies failing and tell you to just give up completely. But this is like saying 99% of job applications get rejected, therefore you should never even apply. Subscribe.